And good afternoon and welcome. I'm Randy Price, and he is Matt Price. We are the Price Group, and our theme for today's talk is, interestingly enough, interesting themes for 2024. It's the 30th of January as we finish January out. For those of you who are new, we'll do this regularly to update you on some things that we're seeing, some trends, some ideas that we want to communicate to the folks that are on our distribution portal. And we welcome you on a beautiful afternoon to talk about themes for 2024. So who are we? We are a family-owned and operated group, 45 plus years of experience, and the most important thing would be that we act as a little bit of a legal term there, a fiduciary. We're looking out for our clients' best interest, and retirement is indeed what we do. Over 82% of the folks that we work with are either close to or retired. So sit back and enjoy. We'll have a time for questions and answers as well, but we'll hope to cover in about 35 to 40 minutes some pertinent information that will be very helpful to you.
Thank you, Randy. In another life, I feel like Randy would have made a great flight attendant. I feel like the plane's just about to take off here. So a few awards to brag on Randy's behalf: Barron's, Forbes, Financial Times. Randy and I both are certified financial planners. Both have our CIMA, Certified Investment Management Analyst designation. Maddie Kearns, also a CFP. And then I think a few of you might have saw the email. We'll be adding our 6th team member later this spring, so stay tuned for that. We'll have some more information to share maybe here in the next month or so on that front. But a little bit about our firm, Steward Partners, based on the biblical definition of stewardship. A little over $32 billion in assets at the end of last year. Raymond James currently serves as one of our 2 custodial options. Custodial options, just the other one being Pershing. That's where client assets are held. We've gotten, I'd say, a lot of good feedback from clients on really enjoying Raymond James statements and some of the other things that come along with that. But overall, they've been a great partner of ours. So look, here's what we're going to talk about today. Just give a quick overview of what we think is going on in the economy. Look at monetary policy. Might not be good conversation for your next date night, but vitally important to your investing before, during, and during retirement. Talk about fixed income, what we're seeing in the equity or the stock markets, and then just some maybe our attempt to take a step back and not necessarily look at only the trees, but also the forest, long-term investing, and some key things to consider to be a quote-unquote successful investor over a long period of time.
So let's kick it off by the exciting topic of the economic overview. Where are we? Well, obviously, this is an election year. There are a lot of things going on in the world, but let's set the stage with a little bit of perspective. Looking back 123 years of bull and bear markets, from the Latin term meaning a long period of time, and you can see here that both green and red, bull and bear, have lasted for more than just a few years all through history. Let's look at the green first, the bull markets, and the most famous bull market there would have been right during the 80s, going right up until 2000. I remember one client very clearly telling me, he says, "Well, Randy, it's really clear. Just invest when it's green and stay away from the red." And I thought about that, and I went, "Okay, that's fair." But what you can see is even in periods where there has been a bear market, and note that 1973 to 1981, the market went up and down, didn't go very much anywhere, but technically it was a bear market, and there's a little bit of a disagreement on the bull market starting in 2009, or really wasn't that, but bull markets tend to last somewhere between 17 and 24 years. Takeaway from this slide, and you see right there where we are June 30th, 2023, or where the last slide here was, And we think that we have some time left here with regards to the run going higher. A lot of things going on, a lot of problems, a lot of potentialities, but we think that stocks continue to move higher. And what was interesting, if you follow the market closely, you saw that for the greatest part of 2023, stocks didn't do much at all. And then there was a whiff in the air of perhaps interest rates going down, the Fed cutting interest rates, and the market rallied the fourth quarter and is started out 2024 as well. But again, we think the market does continue to move higher. So let's talk about the rotisserie economy. Different areas of the economy have been hit at different times. And on the positive, the spending for air travel, for leisure, hospitality are much higher. On the flip side, interest rate sensitive sectors, as you might imagine, as interest rates have moved higher, have moved lower. Existing home sales, mortgage rates going higher, manufacturing going lower. Also, a lot of people that you may know have mortgages 2 and 3%. Now we're talking 7 and 8% on mortgages. So obviously you can buy a lot more house, but anytime someone buys a house, if they're not a home-time buyer, there typically needs to be a sale on the other side as well. So home spending and home sales are a big factor, as well as car sales in the economy. And when interest rates go up, those all get more expensive. So are we going to have a recession or are we not going to have a recession? The problem with a recession is it sort of sounds like that bad word called depression, and totally different, different situation and circumstances. By definition, just to review, a recession is 2 straight 3-month periods, a quarter, where the economy shrinks a little bit. Economy can shrink a little bit, economy can shrink a middle amount, economy can shrink a lot. And for most recessions, unless somebody told you about it, the mild recessions really are hard to even know unless you're reading about it in the newspaper. But we look at a number of indicators on a regular basis. Is the economy growing? Is the economy slowing? And the real-time indicators are showing us that the labor market is slowing. Services and travel spending has been good, but it is softening. Hotel occupancy at a seasonal 3-year low. Restaurant performance slowing. And luxury watch sales are a little bit lower. And architectural billing is slowing as well. Now, some people would say, well, Matt, Randy, hey, this is an election year. Have you forgotten all about that? And we'll soon all be reminded on a daily, regular basis that it is an election year. But a recession in election years is not totally uncommon. We've had actually 3 recessions in the 4th year of a presidential term. And again, that's just one more factor to consider as we look at economics and we look at what's going on to determine where the best place for investing your funds really is on a risk-return basis.
Here was one of my favorite slides we put together for this presentation. You've probably heard us talk a lot about humans being linear thinkers. And what I mean by that is we have a little bit of what we call recency bias. It rained almost every day last week here in Houston. And I had this thought this past weekend, when is it going to stop raining? Almost, is it going to always rain? And so we do that also with financial markets. We think back to the most recent recession, which would be 2020, where the economy essentially just fell off the side of a cliff. But before that, 2008, 2009, the financial crisis. And so we think, well, a recession would probably look something like those, since those are our 2 most recent memories of recessions in the past. But you can see here, our expectation is a very, very, very mild recession. So we don't think it's something that we necessarily sell stocks and move to the sideline. It's something that we want to make sure we know what we own and why we own it. We've written here over the past month or 2, we've actually increased the credit quality for a number of our taxable but also tax-free bond portfolios. And we continue to be really comfortable with the quality type of stocks that we own in our dividend growth strategy. And we have one other dividend stock strategy that also has real fundamentally sound companies being the goal there. So mild recession, and we would say that happens summer, maybe second back half of this year. Here's why we think it's a mild recession. No major economic shocks. This one's kind of hard to predict. You know, at the beginning of 2020, neither Randy nor myself nor anyone thought that some virus would really derail the world's economy. So kind of put an asterisk there. If China invaded Taiwan or some other geopolitical tension were to erupt, this would be a due cause to kind of change our thoughts on how much of a recession we would experience. We started with really job losses being historically low. So we started in a good spot on that perspective. You know, the third one here, positive government spending, a little bit of an oxymoron. We think long-term, it's really not positive to have the degree of government spending that we do have. However, in the short term, thinking about 2024, it would help to mitigate having a deeper or darker recession. Productivity is increasing. Household net worths are at a record high. You know, this kind of translates to people's 401ks are the highest levels they've ever been, which makes people feel wealthy. When people feel wealthy, they go out and spend money. And then, as we've talked about in webinars in the past, the consumer spending money is responsible for approximately 2/3 of economic activity, which is a really big deal. So those are kind of why we think we have some, I'd say, tailwinds. If there is a recession, we don't think it's going to be as deep as the last two we have experienced.
So if you enjoyed the economic policy, you're really going to enjoy the monetary policy, and that's a little bit tongue-in-cheek. But let's get into some hopefully useful information. The Fed finishing the meal is how we've titled this slide, and the Fed always wins. But looking at the ingredient list for the Fed tightening cycle, you've got some goods pricing moved lower: TVs, appliances, used car and trucks. Services rolling over, utility gas service, airline fares, so on and so forth. But shelter is keeping inflation elevated. And, you know, inflation is the hidden tax. Divide the inflation rate into 72. We call this the rule of 72, and it'll tell you how long your cost of living will double. Just a reminder, if you have 2% inflation, 2 into 72 is 36. So the cost of living doubles every 36 years. Not an issue at all. But if you get into 7% inflation, the cost of living is going to double about every 10 years. And so you can see how that will make a big difference. And you can think back on inflation as what it used to cost to mail a letter, and how the postage rate just seems to be going up and up and up. But that's a nice barometer to sort of keep track of that. So the Fed is finishing the meal with regards to what they are doing. So both employment and economic activity have eased in the recent months. See the U.S. labor market easing. Chart on the left. Forecast is 1 million jobs lost versus the historical average of 3.5 million. And think about this: if you're a company, what are your big expenses? Your big expenses are borrowing money and paying employees, two of the largest. And so when the cost of borrowing money goes higher, unless you've been able to pass that on to your customers, you're going to have to find some place to cut some expenses. And for many corporations, that's going to be on the labor side of things. One company, just reading news here just before we started the webinar, is going to reduce their head count in 2024. And what happens is you'll probably continue to see a little bit more of that as companies try to right size and make sure that they are in the best position. Companies can tend to get a little bit fat and flabby during periods where all things are good. And unfortunately, during recessions or when the market does turn, some people will lose their job. The labor market is turning a little bit negative here for we think the second quarter of 2024.
So we think the Federal Reserve has hit the finish line with raising interest rates. The last interest rate, just for perspective, was back in July of 2023. So it has been a number of months since they last raised interest rates. The way they kind of talked about it is they haven't closed the door yet, but they could potentially raise interest rates again. But we think that's an off chance of happening. We think actually the more likely scenario is that they would cut interest rates, possibly the second back half of this year. And the reason why we think that, historically, look at the chart there on the right, election years really haven't swayed the Federal Reserve. You've gotten cuts almost 2/3 of the time in an election year. And the chart there on the left, the Fed begins cutting rates prior to hitting their inflation target of 2%. And so there's been great progress made on reducing inflation. We're not all the way to that 2% bogey, but progress has been pretty consistent up until this point. And, history, we like to say here at the Price Group, it typically does not repeat itself, but it often rhymes. And so we think something that we're looking at here is very helpful, just looking at past times when the Federal Reserve has started that interest rate cutting process.
And Matt, it's, I think, important to just remind people that bond investors, stock investors are looking forward. The markets tend to look out 6 to 9 months. And so when that first whiff in the air of the Fed cutting interest rates, that really was a boom to the stock market back in the fall of last year, 2023. And so it's not, we hear people say, well, let's wait till it sort of dies down or slows down. And the market, that's what makes it difficult to try to time, is forward looking on both interest rates as well as stock prices.
Yeah, great point. So 3 to 4 interest rate cuts is our projection, most of them happening toward the end of this year. That would affect rates on money market. And that's a good transition on, a question we've gotten a lot this month is, well, if interest rates do move lower, how does that affect bonds or fixed income? So let's take a look here.
And Matt, one more thing there is we've got a lot of money that clients have sent us from banks. The banks are paying 0 interest, and we're still getting over 5% in an institutional and money market. And our thought process has been, this is a good place to park money, but cash is very rarely a good investment. So, the thought process is, if you're expecting rates to drop at some point, maybe rather than owning a lot of money market, maybe you own a 1-year tax-free bond and a 2-year tax-free bond, a 3-year tax-free bond, or substitute a CD if it's an IRA. But lock in some maturities to make that higher interest last longer, if you will, because again, we've seen the movie several times. When interest rates go down, they sometimes can go down quickly.
Yeah, another great point. And to that end, kind of what Randy mentioned earlier, yields move lower in advance of the next easing cycle. So if the Federal Reserve were to reduce interest rates in the middle of April, say, just hypothetically, interest rates typically, if we look back at history, start to move lower before that. The market kind of gets a whiff in the air of it. And so the end of year forecast that we have for the 10-year U.S. government bond, which is one of the, I'd say, primary barometers for interest rates, is at 3.5%. We're currently just hovering around 4%, so that'd be a pretty material move over the next 11 months. But bottom line is this: we think it's a good kind of the backdrop for 2024 being a good year for bonds set up really well. And I'll let Randy kind of talk about that here in more detail.
Yeah, a little bit of perspective is, seems like it was not too long ago that the 10-year US government bond, which basically is used to set mortgages and a lot of the companies hedge off of, very popular quoted rate, was down at 1%. And then we touched 5% just for a couple of days, couple of hours. And now it's back to 4. So you've seen interest rates really move. And what bond investors are trying to seek out is, how much inflation is really there and how much is in the economy, and is it short term, medium term, or long term? We think that a review here of bonds is that interest rates and bond prices move in inverse direction. Think of a seesaw. Interest rates up, bond prices down. So when interest rates went from 1% to 5%, people saw their bond portfolio lose value. But we've seen from interest rates coming down that does just the opposite. It buoys the price of bond. And prior to 2020, ultra low yields were a real source of risk. And so now, if you need income, it's much easier to make money because bond rates are higher. The 10-year Treasury hypothetical 1-year return, again, with a 1% increase or a 1% decrease, you can see there in light blue as well as dark blue in 2020, 2023. And you can see it's much more palatable to invest in the bond now because it's got a higher coupon, and that higher coupon, the interest it pays, will cushion the downside. So to compare 2020 with 2023, if you owned a 10-year US government bond in 2020 and interest rates went up 1%, you look down and wow, you were 9% lower. And hey, that's no fun. But if in 2023, if you have a 10-year government bond and interest rates go 1% higher, you're only going to be down 3.7%. And that's because you're getting so much more interest in 2023 than you were in 2020. And same thing, the math working backwards on the decline. So fixed income outlook, reasons we here at the Price Group favor high quality over speculative or lower quality investments in bonds. The valuations, the default rates, the corporate health, refinancing risk, macro environment. Valuations remain near the highest level in 15 years. Default rates, investment grade corporate bonds rarely default. Municipal investment grade bonds even less than that. But the highest default rate in the last 20 years was 0.75%. That occurred in 2008, the Great Recession. Corporate health, many, if not most corporations entering the year are in good health, strong balance sheet, low net interest cost. A lot of these companies locked in some low interest rate debt. But there is a chance on some refinancing. If you're a company and you've got a lot of bonds coming due and you've got to refinance, you've got to go back into the market and sell new bonds. Of course, the level of interest rates, the stature of your company, and a number of other factors go into determining how good a deal you will get. And then big picture, the macro environment. Again, we thinking there's going to be a mild recession. Corporate earnings are unlikely to collapse. And it's really a period like 2008 where corporate earnings really collapsed, where you lead to the recessions that people really remember, and they hurt more. It's those deep recessions. You may remember if you were around, stocks swung almost 50% from top to bottom during that time frame and period. And so we think that the macro environment is not going to get nearly as bad as that. And again, in our portfolio, we've rotated out of some higher yielding bonds into some higher quality bonds as ballast, if you will, to the tank. And we think that's the right place to be at this time in the economic cycle.
So let's take a look at the equity markets. This is a little bit of a busy slide, but what this is essentially saying is that we said earlier that the Federal Reserve increased interest rates most recently in July of 2023. This is the performance of the stock market after the peak of when the Federal Reserve increased interest rates. So draw your attention down here to the 1 year number. So 1 year after July of 2023, on average, the market's 9% higher. We've made a pretty good move since July already. There are periods there where the market is more than 9. There's obviously periods there that it's less than 9, but that's just the median performance. The bottom line is this: the Federal Reserve reducing interest rates is more of a tailwind to help stock markets. So we like we said, we think the Federal Reserve starts to ease lower rates, which would be helpful if you're in the camp of wanting stock prices to move higher. And a little more kind of meat on the bone of why we think we're optimistic heading into this year. Markets positive each of the last 11 re-election years. So we think that's good from a standpoint if we do want markets to move higher. We just talked about the positive performance after the Federal Reserve cuts interest rates or lowers interest rates. And then momentum in returns typically continues. And so after you have, we did this, if you're getting our emails, our Friday facts from Friendly Fiduciary. It's a little bit of a mouthful to say. We talked about how last Friday, after a good year in the market, when the market's up 20% or more, it's typically followed by another year in the market. Not up as much, but typically a positive year does follow after having a good 2023 like we experienced last year. So don't pay attention necessarily to the numbers that much on the left. These are the S&P kind of targets that we have in place that's a little too granular or technical maybe for this presentation. But our base case is this: we think the market is up mid to high single digits for the year. There's some room where it could move higher. We could be wrong and have a much more deeper, darker recession than we're anticipating. Credit markets could tighten up. The Federal Reserve could not cut interest rates like most everyone is expecting at this point, and that could cause the market to move sideways, move lower. But yeah, base case, mild recession. Think the market does move slightly higher between now and the end of the year. And this is, we got a question, I think it was last week. Well, we were looking at a client's 401k, and the client asked, well, shouldn't I just buy the S&P index? And, the index is fine. When you get into retirement, though, we think you should be more aware of what you own in that index. And so what you can see here, these are the top percentage ownership within the S&P 500. And what we're tracking here are the forward price to earning ratios. And all that's saying is how expensive is this stock compared to the earnings that the company is currently making. And for perspective, typically the market gets expensive when it's 25, 24, 23 times earnings. We typically start saying, ooh, it's a little too expensive for our taste. And you can see a lot of these stocks that are the top holdings within the S&P 500 are well above that 22, 23, 24 metric. However, look there to the right, the rest of the S&P 500 is only trading at a 17 multiple, so 17 times earnings. And then the smaller you get, the S&P 400 or the S&P 600, they're actually more cheap on a relative basis. So I know this is a little bit technical. The bottom line is the market might look overly expensive based on just a handful of stocks that we've listed here. And if we kind of peel the onion back, we think there is still a lot of good value in other companies across the board that do pay dividends and that we are still comfortable owning at these valuations.
So one of the most common question is, why shouldn't I just own the Magnificent Seven, which obviously are the seven largest stocks, make up about 35% of the S&P 500. One of the next most common questions is, when are the international markets going to do better? And right now, we think the United States is the cleanest shirt in the dirty laundry. You look there at GDP growth, you look at earnings growth, you look at net margins, you look at dividend growth, you look at country ranking on a weighted composite, and even with all the issues of overspending and craziness going on in the country, the United States is still a good place to hang out. You can get international exposure through companies that are domiciled here in the United States, but sell goods and services across the country. And again, you can get into dollar versus the pound, or dollar versus some of the other currencies, but our portfolios, we feel our portfolios are, and it's our thought process and investment recommendations, that the preponderance of things are still domestically owned equities. And at some point that may change, but for right now, we're staying the course. So the energy sector has some upside, strong fundamentals, and potential contrarian play. Energy trading at the largest discount to historical average, highest free cash flow, and strong fund outflows all make energy something to feel comfortable with. Obviously, if you've worked at a big multinational oil company, you probably still own a piece of your stock. And again, for right now, we think a good time to possibly to look to energy, and energy makes up a nice portion of our portfolio. But no matter how positive we are, we're not going to ever be way overweight in any one sector. So turning up the heat on the volatility in 2024, Matt mentioned geopolitical risk, and again, one issue that he cited was China and Taiwan. Taiwan's got a new leader, and but China's supposedly dealt with that fairly easily. If China would invade Taiwan, where would we get the semiconductors to make cars, etc.? So the geopolitical risk, either from the Middle East, or for Ukraine, or from China and Taiwan. And then we see equity volatility also increasing in a presidential election year. So a lot happening this year. And what does all that mean? What it all really means, you need to have a process, if you will, to look at both stocks, a process to look at fixed income, and a decision, hopefully, that you're not being too emotional about your decisions, and processing information without the recency bias, etc., that Matt talked about earlier.
So that's all our prepared remarks as it pertains to the economy, monetary policy, stocks and bonds. We thought it'd be helpful, though, to take a step back and look at investing just long term for a moment or two. And another busy chart here, but a balanced plate is beneficial. It kind of sounds like something I tell my kids before we eat dinner every night. Eat your veggies. Balanced diet is good. The boxes here with the red squares around them, this is a blended portfolio, part stock, part bond inside of there. And what you can see, or what I want everyone here to kind of notice, is it's never at the top. It's never the best performing asset class, but it's also never at the bottom. And this is a look from 2006 through the end of last year. And retirement, Randy mentioned over 80% of our clients are retired. In retirement, we're not trying to outperform some arbitrary index for most clients. In retirement, we think you win by not losing. And a big piece of that is having a blended portfolio, having different investment strategies that complement each other. Randy used the term ballast to the ship with some of the high investment grade bonds. We think every piece of the portfolio serves a purpose. And we think the key to having a successful retirement is win by not losing. So we also did the math on looking back here. What if you invested in the best performing asset class each year? For example, in 2009, real estate, 10 real estate, 11 fixed income. So at the end of 2011, you decided, you know what, fixed income is doing really well. I'm going to put my money in fixed income. And you did that every year, picking the best performer from the previous year. How would you have done? Well, you wouldn't have done that well. You would have been down about 5% per year. So we think there's some real truth that, Warren Buffett, he has a famous saying. He says, neither I nor you are smart enough to know what will happen to the markets within a year from now. And so if Mr. Buffett is not smart enough, I'm not smart enough, Randy's not smart enough, none of us are. And so we think that is one of the key reasons we continue to preach diversification and having different investment strategies within your retirement portfolio.
Very well said. So not all winners stay winners, and chasing returns can be very enticing. I'm reminded of you've seen the person on the road and they're going from the left lane to the right lane to the middle lane and trying to and then you pass them right as you get to the exit because they've been in the wrong lane at the wrong time. But following the flows is not a positive strategy either. What you'll find is that when stocks go way down, you'll see most people sell. But if you go to Walmart, etc., grocery store, and something's on sale, what do you usually do? When it's on sale, you usually buy more of it. And so if you can get in the mindset of doing that, buying things when they're on sale, looking forward as opposed to looking sideways or backwards, you become a more proficient investor. And again, having a process for both the stock side, having a process for the bond side as well. Speaking of processes, we do have an income-oriented investment process that makes sense. Retirement is all about income, and no matter how good a company you've worked for, they've got this habit of stop paying you when you check out for the last time. So compound average returns from 1986 through 2022. You can see that dividend growers are at the top of the list. They're over dividend payers. They're over the S&P 500 stocks. They're over dividend cutters and dividend non-payers. And we think that dividend stocks are one of our secret sauce in that discipline, income generation are our core principles. And we love dividend stocks because if we're doing our job right, you'll get a raise on a regular reoccurring basis. And even if stocks, the market as measured by the market, are down 10, 15, 20%, your income will not be down. And if you're good on your income, you don't have to change anything in your style or standard of living to take into account for a lower market. But our ultimate goal here at the Price Group, we want to preserve your assets, generate the level of income, the level of growth that you need to meet your objectives with confidence. And confidence is just a piece of the pie. We give clients clarity. Clarity will lead to confidence. Confidence will lead to the ultimate comfort. And who does not want a more comfortable retirement, a more comfortable lifestyle? But again, it's the 3 C's, comfort, clarity, and confidence, we think, that separate our holistic driven planning as well as our process driven investment strategies. So we've covered a lot of ground, and the trains have run somewhat on time this morning, I'm happy to report, or this afternoon. So, Matt, questions?
No questions yet. Shoot us an email, give us a call if you do. Just as a reminder, we're trying to do 4 more what we call beefed up presentations like this. That will be 30 to 45 minutes long. And then in the other 8 months of the year, our monthly market update will be a little bit of a shorter presentation, 10 to 15 minutes for clients to check in if they're interested. So we'll be sending out February's invitation here in the next few weeks, but certainly appreciate everyone attending, and we'll look forward to catching up soon.
Yeah, if you're not on our email list, certainly there's no cost or obligation, and we feel like that's a real learning opportunity. Sort of what we're thinking on a weekly and sometimes more than weekly basis. That's Tiffany, that's Matt, that's myself, that's Maddie, that's Melissa, and we are the Price Group. Feel free to reach out to us, email or telephone, and again, we're happy to try to address some of your questions. So until next time, we're the Price Group. Everyone needs a wealth coach. Have a great afternoon.